morning and thanks for joining me this morning for our webinar on cash flow. My name's Kristy. I'm a presenter and an advisor for Business Station as part of the Digital Solutions program. Now today what we're going to go through is just some basic principles of managing your cash flow, a bit of a disclose or a statement to disclose that I'm not an accountant or a bookkeeper, so my experience really comes from the operational side of business. Managing my own businesses and that of other small businesses and really working with cash flow. So we're going to go through a bit of the background in that sense, but if there are any specific bookkeeping or accounting questions, then I would encourage you to reach out to those people that you have within your organization or that you use on a contract basis. Now, today's webinar is designed to be interactive, so please do use the Q&A functionality or the chat box to ask any questions. I'll also stay online at the end of the session to allow time for questions. So if you think of anything towards the end, then that's absolutely fine as well. Now, in terms of what we're going to go through today, well, you're going to first of all gain an insight into the cash flow process if you don't already understand it, and we'll look at how you can manage it. We'll also discuss what cash flow actually is, and then we'll talk about the difference or perhaps even the relationship between profit and loss and cash flow. You will learn how to create your own cash flow forecast, as well as how to develop an analytical approach to your cash management by effectively tracking your performance. So towards the end, we'll look at strategies to stretch your cash flow further, which is always the great part of the webinar as well. Okay, so to get started, what is cash flow? Well, cash flow is essentially a term that's used to describe the amount of cash in actual dollars that's generated or consumed in a set time period. So cash flow has a lot of uses, both in operating your business, but also in a bit of a forecasting or financial analysis. I do believe that it's one of the most important metrics of all finance and accounting because it becomes, well, it really is the lifeblood of your company. Managing your cash flow means that you can evaluate that flow of funds into the business and out of the business and identify where and when there may be potential problems. So understanding cash flow really becomes a key to your business success. Once you find out how to manage it, you can then identify ways to stretch your cash flow further. Now, there is a comparison between cash flow and profitability. Profitability tends to be the ultimate goal when it comes to the financial side of running a business, but you don't generally determine true profitability until the end of a period of time. So normally it's something like, the end of the financial year. And that's really the key difference between cash flow and profit. Profit looks backwards, whereas cash flow looks forwards. Profit will pretty much indicate the amount of money that's left over after any of your expenses have been paid. And like I said, normally end of a financial year. And then making a profit pretty much just means that you've made enough sales of your product or service to cover all of your existing costs, which are your expenses, and you've got a little bit to spare. Cash flow, on the other hand, is that net flow of cash coming into and out of a business at any particular time. So generally speaking, it's outlined in months, but you could really look at your cash flow and forecast based on weeks or even years, really depending on how you set up your reporting and how the flow of funds comes into and out of your business. But certainly the most common is by way of months. Now, cash flow does matter, and it matters a lot. If you have a positive or good cash flow, it means that you're going to have enough money to pay all of your expected expenses, and you're going to be able to pay them when they're due. You'll know when you're able to do things like reinvest in the business or potentially even purchase capital or other assets that you might need to actually grow your business or even to run it more efficiently. So you'll also see when it's appropriate to take money out for yourself or return money to shareholders. Cash flow also, or understanding your cash flow and having a positive cash flow is more like an assurance that you've got a buffer to cover against any future financial challenges. Now, they could be unexpected things like, complete equipment failure that's resulting in replacement. There could be legal expenses that crop up, really anything unforeseen, and things do pop up. So you get that, you have that assurance, that you know that you can sort of cover them. Now, if you've got cash flow problems, that means that you don't have enough money in the bank for those necessary things, let alone anything unexpected that might arise. So if something unforeseen did pop up, you'd be in a really difficult place. Now, you do have to keep in mind that you can have profitability but suffer from cash flow problems. So you could have situations like clients paying late, or you could have early paying terms to your suppliers, or a combination of both always results in bad cash flow. And they're kind of the main two reasons why businesses do have cash flow problems. But figuring out your cash cycle and your payment terms is absolutely crucial. And it's really one of the first things that you should do in terms of looking at how you can keep cash flow positive. Now, if you have an existing business, an already established business, it's really important to continually analyze cash flow and have a look at and be forecasting how things are looking year on year, month on month. If you are a startup and looking at it from a startup's point of view, your first goal really has to be maintaining positive cash flow. And then once that's under control, you will then be pursuing that ultimate financial goal of making it as profitable as possible. But at a bare minimum, you need to know what sales you have to make in order to cover the outgoings. Now, tracking cash flow is important, and this is a really crucial step of what we're going through today. It allows you to operate profitably and generate positive cash flow, or make necessary changes to improve it. So, for example, you might identify that you need to reduce certain expenses or increase revenue in particular areas. And having that knowledge in advance gives you time to actually to implement changes to make that happen. It also allows you to look at what's working well and what's not. Now, I like to split that up by products and services so that you know what are your most profitable products and services and what are your least profitable. You can set budgets based on what you know you need to achieve at certain times, and then track it against how you're actually performing to make sure you're meeting those budgets. It also allows you to be sure that you have enough cash, or to determine how you can get input. So that input might need to come personally. You might need to seek investors or sell off assets. But you need to, understand if there is cash that you need, or if there isn't a period of time that you need input. It also allows you to make informed decisions on various areas of your business. Now, that could be decisions on purchasing, it could be staffing, it could be sales and discounts, for example, to generate more sales. It could be leasing or, renting bigger premises or anything like that. It's just really about making those informed decisions based on what you've forecasted. And with all of that knowledge, you'll be sure to reach your business goals. Okay, now since cash flow does matter so much, it's only natural that you'll do everything in your power to increase it. So forecasting and knowing exactly when you'll have those inflows and outflows becomes absolutely crucial. And to be able to forecast accurately, you have to map it all out. Now, there are a lot of templates that are available online. I find that the best are those that are on the Australian government websites, and which I'll sort of talk through, but there are banks and other, accounting firms sometimes have them downloadable. Normally they're in an Excel format, and normally they're free. So I'm going to go through an example in just a minute, but you need to find a template that you like. And once you have your template, essentially to get started, you'll decide the period that the forecast should cover. You'll add in all the cash inflows and then deduct the cash outflows for each period, usually month by month. As I said, you might make that more specific and make it weekly or even quarterly, but normally month by month is sort of a typical scenario. If you have an existing business, a really good way to start this is to get all of your data from previous years from your accounting software or even from your accountant, depending on what access you have. and input it into your forecast, and then decide what adjustments you'll need to make based on past trends. So you might know that sales are increasing or decreasing, or perhaps even staying the same. You might know that there's expenses there that were one-off that you're not going to incur in the future years, or you obviously have to analyze the data that you're inputting. Now, I did touch on this, but if you are a startup or a new business, when you prepare your cash flow forecast, you'll have to start by estimating all of the cash outflows. Now, and I'll go through some areas that you'll have to either estimate or get quotes for when it comes to insurance or renting space, those kind of things. But once you do that, you'll then get an idea of how much cash needs to come in to cover, at the very least, the outgoing. And that therefore will tell you what sales you need to make to cover that. Now, keep in mind, sales figures do always change because they do depend on a lot of different factors. Now, this could be the type of customers that you sell to. It could be how quickly they have to pay you. Perhaps it's what the economy is doing. So, interest rate increases or unemployment rates. Also what your competitors are doing. So when you are forecasting any sales, you have to be realistic. This has to be based on not a stab in the dark. It has to be really based on research, either past data from your business and knowing trends around your business, or a thoroughly researched analysis of your market and an estimation of what your sales might be. So there is a bit of assumption required there. Obviously, research, analysis, and assumption. Now, what you see on your screen is a template. Now, this is one that I like, and it's a good starting point. Like I said, there are a range of different templates available online, normally free and downloadable in an Excel format. So what you see here on your screen will show two areas. Now, I'll just hover over them. You've got your opening balance, because cash flow is all about how much cash you have on hand. You would normally always enter an opening balance. Then you would estimate your cash incoming. So this could be sales of various products. It could be asset sales if you're planning to get rid of some assets. Debtors may pay on a cycle. Now, you might make a sale in July, but because of a debtor agreement, you don't get that payment till August. So there could be some sales, cash sales coming in July, and then debtor receipts coming in August, if that makes sense. Any loans that you might be taking out that will give you an injection of cash into the business, you can factor in here, or any other income. Now, that could be, it could be GST rebates or tax refunds. It could be owner investment of cash, if you're planning on adding extra equity in the business. There could be government or other grants or funding. There could be royalties. You might be collecting franchise fees or license fees. Anything, any funds that are incoming will go into this section here. That will then give you a total of that month of what's incoming. Then you have to look at your outflows. Now, outflows will include all running expenses of your business. Plus, you need to consider things like if and when you're buying new assets, if you have any one-off bank fees, such as, loan establishment fees or anything like that, any loan repayments that you need to make as well, payments to the owners. So if you're the business owner, payments coming out to yourself. And don't forget also to account for GST, PAYG, super, any other ATO sort of liabilities there. But otherwise, it's everything else that's relating to the operation of your business. It will be sales and marketing. It could be accounting fees. It could be your rent and rates, leases, loans, vehicle expenses, stationery. Absolutely anything and everything needs to be input here. And obviously with these types of templates, you generally have the ability to add extra columns here or extra rows here so that you can add more and really tailor this around the specific expenses within your business. That will give you a total outgoing. So your monthly cash balance is going to be your incoming. So your total incoming less your total outgoing. That'll give you monthly cash balance. Now, your closing balance will take into consideration what you had to start with. So if you had $1,000 here, then you had $1,000 incoming, that would make $2,000. Let's say you had $500 outgoing, you would have a closing balance that is the leftover there. So that would be $1,500 essentially, whereas your monthly cash balance would just be your $1,000 less your $500. So it would be $500. So, and then that will roll over. This closing balance will go up to the opening balance for the following month, and it will accumulate like that. So you might find that, you know, July, August, September, they're all good months. So your money is accumulating. So here your closing balance is looking really good. And then over November, December, January, you're closed for 3 months, for example. So you have no cash incoming. So you will start to, your monthly cash balances will all be red, but you still have leftover closing balance money because you've accumulated it in previous months. So this is the purpose of having both a monthly cash balance and a closing balance. It allows you, and a lot of businesses do operate seasonally, where you will have really, you know, peak times, and you'll need to hold on to those funds to get you through the quieter times. That's very, very common. But what is also common for small businesses is that you see all this money in your bank during those peak times and go, excellent, I can go and buy this and buy that. And, you know, you spend some of that money and you cut yourself short at these, you know, whatever your lower times are. So that's the purpose of this, is really to map out if and when there are any problems. Okay, so now we're going to start having a look at tracking your cash flow. In terms of mapping out your cash flow, once you've mapped it out by way of a template or something, you know, like I've just shown you, or any other template that suits your business, you've input all past data, you've forecasted some sales, you might have identified times, whether that be periods of time, or, you know, lot of seasonality. So it could be just 1 month that there's issues, or it could be 6 months that there's issues. You'll have to identify, or you will identify where there might be any problems and if you need to improve it. Now, whether or not you show a profit or a loss on your cash flow statement, so either way, you should still be looking at ways to improve it, because that will equate to more profit for you. Now, the strategies for improving your cash flow fall into generally 1 of 3 categories. You've got revenue growth, you've got operating margins, and capital efficiency, as you see on the screen at the moment. So we're going to look at some of the key areas within those 3 main pillars, but depending on the nature of your business, it is worthwhile looking at all areas of your cash flow, depending on, like I said, what's relevant to your specific industry and your specific business. Now, a lot of what we're going to go through is relevant to all businesses, but a lot of it is really marketing, strategic marketing. But first, you need to understand your position to be able to improve your marketing, which subsequently improves your cash flow. So just to expand on those 3 pillars, you've got revenue growth, which essentially is your volume of goods and services sold, or the price of what you're selling it for. You've then got your operating margins, which is your cost of goods sold, and your selling, general and administrative expenses. You've then got capital efficiency. Now, capital efficiency is really just a question of how efficiently you're using your cash to operate and to grow. So looking at things like property, plant and equipment, and inventory. And you can see sort of the sub areas of that. Now, we're going to start looking at some of these areas now. We will go through them one by one. So as we do, just think about your business and think about what might be relevant. And do keep in mind that it is largely marketing related. Okay, first of all, we're going to start with pricing. Now, many different businesses that I deal with, or when I first start working with them, it really doesn't matter what industry you're in, don't really know if the price that they're charging is right, or aren't really aware if the price that they are charging is covering costs. The other thing that I find is that a lot of businesses don't actually know if specific products and services are actually profitable, or if they do better than others. So thinking about your business, do you know what are your most or even your least profitable products and services? And then considering that, how can you increase the products that are most profitable and decrease the time that you invest in the less profitable products? Because you do have to understand how much time is invested in each. Now, once you've set your price, you need to think about how you've set your price as well. So there's a few different pricing strategies. You can set your prices based on cost plus, which is just what it costs you plus a markup. Your prices could be competition based, which is where you essentially just look at what your competitors are selling for, and then charge over or under that. Or you could base it on what the customer is willing to pay. Now, in my opinion, you have to look at all three of those elements to be effective. You can't just base your pricing on what it costs you plus a markup, because you might not be competitive. But similarly, you can't just base your pricing on what the customer is willing to pay or what your competitors are doing, because you might not be covering costs and you might not be making a profit. So you do have to know what your competitors are doing, but you also must know your worth as well. So here is where sort of the marketing side of it comes into it, where you identify your weaknesses or any gaps in what you're offering when you're doing research on what your competitors are doing. And then you can make sure that you offer a fantastic product or service that is superior to your competitors. So identifying those weaknesses or gaps and doing something about them. So very much part of your marketing strategy. What is it about your product or service that's unique or different, and what sets you aside from your competitors? Generally speaking, you could charge more because you have some superior quality to your competitors, or you might want to base your pricing on more volume, less profit. So keep in mind, when it comes to pricing, discounting equates to doing more work to make or maintain a margin. Whereas if you increase your price, you're doing less work and possibly fewer customers to maintain a margin. Now, in saying that, increasing a price could potentially cut a market out. So where you just get to that point where a certain market just can't afford what you're offering. But on the flip side, decreasing the price or discounting too heavily could mean that you do make a lot of sales, but you attract the wrong market. Now, some of the group buying sites are a really good example of that. So, you've got sites where you can get vouchers for 50, 60, 70% off. And it could be, you see this a lot in the beauty industry, where you can go on and buy, whatever it is, a facial, for example, and you can buy it at an extremely discounted rate. So I might go online, buy that, but I have really no connection to this business. I just wanted a cheap facial. So as a customer, I might not buy any additional products when I've had the facial. I might not be loyal, so you might never see me again. So you're kind of doing all this work to get me in the door, charging me next to nothing, but then you've got no repeat customers. So those kind of things are a major consideration. Sometimes that volume of sales isn't actually worth it because you've discounted the price so much to get to that. So really understanding your pricing is absolutely crucial. It's a core part of your cash flow and also your business, your general business operations. All right, so now we're going to have a look at volume. With volume, you have to consider here if you could increase your volume overall, and specifically the volume of those more profitable products and services. Perhaps there's new markets to sell to, perhaps you could create new products, or you can improve your sales processes to allow you to produce more, I should say. But we do look at a bit of a table here, which is, this is a profit enhancement strategy. So in this table, you can see a couple of different areas here. The first one in blue is market penetration. That's where you have an existing product and an existing market. So that really occurs when, as a small business, you try to penetrate a market. And in that market, there are current or similar products already exist. So you're really just trying to gain your competitors' customers. The next area in green that you see there is product development. Now, this is where you develop new products for existing markets. So perhaps you want to launch a new product or services. Maybe you've identified through researching your competitors or through tracking trends that there is some other product or service that you can launch that will appeal to your existing customers. So something else you can sell them. You've got in the orange there, market development. Now this is creating where you've got, existing products and you're looking for a new market. So you're trying to develop new markets. And here you're kind of thinking about, could you broaden your scope to a new market. And we saw this quite a bit throughout COVID, where you would have a bricks and mortar store that just didn't have the foot traffic, so they went online, or you had a tourist sort of market, and all of a sudden there weren't any tourists coming in because of border closures. So then you would have to aim your existing product at a new local market, essentially. So that is quite common. And I mean, in difficult times where your market just stops abruptly, you really have to look at how you can sell your existing products to a new market. So like I said, we did see a lot of that over COVID. Now, the last element that you see there is diversification, and this is new markets and new products. So could you spread as a business into new areas and sell something completely different to your existing core product to a completely different market? Again, there was a bit of diversification that we saw as a result of COVID, where you didn't have anybody that would buy your products or services, so you had to look at a completely different market and different products. You have to be careful with diversification, that it doesn't dilute your existing business, and also that it doesn't take away from your general business operations. So you really don't want it to distract you, particularly as a small business, away from what your core business is. Now, in terms of volume, some other things that you consider are, like I said earlier, what your sales processes are like. Now, could you improve your sales processes to allow you to sell more? Are there any bottlenecks in the process? Now, sometimes you see this with investing in business assets or, capital equipment, that kind of thing. Perhaps you could, in fact, sell more if you improved and invested in additional equipment. Another thing to consider in terms of increasing your volume is increasing your advertising. Now, advertising has a spend to it. Of course, you have to know that you're advertising to the right market. So all of that research has to exist. Your pricing has to be right. You have to know what sort of strategy you're going for here. Is it market penetration, for example, where you've got existing products and existing markets and you're just trying to increase that? I would also look at your salespeople. If your salespeople are good, make sure that you've got a good plan in place to attract them, or to retain them, I should say. If you need new salespeople, make sure that you've got a plan in place to attract them. Customer rewards programs to get people back is really important as well. So have a look at your repeat sales. Now, it costs something like 8 times more to attract a new customer than it does to keep an existing, or to get, an existing customer coming back. So, that in terms of volume, that is a really core area of improvement, is just simply to get your existing customers back. Okay, the next area to improve your cash flow sits with your debtors. Now, a very interesting ATO stat for debtors is that small businesses in Australia are owed $26 billion at any one time because of debtors. So that's a huge statistic, and that's, like I said, that's small businesses. So small businesses are out of pocket because of their debtor situation. So the best ways to address any issues with debtors are, first of all, prompt collection. So collect payments as quickly as possible. I would even look to offering a discount for prompt payment. Some businesses have things like late payment fees. You have to consider what's going to be most suitable to your business. If you're a small business and have a very close, tight-knit sort of customer base, maybe a late fee isn't ideal, but it is common practice as well. Invoicing earlier is a great idea. So some businesses will wait to the end of the month to invoice. I would say just invoice straight away, depending on your type of customer. Now, not all businesses have debtors. Sometimes you'll just have cash payments, which is great. But if you do have debtors, have a look at your customers and how often are they purchasing. Now, in terms of, you might have a customer that purchases from you 20 times a month. In that case, you don't want to be invoicing them every single time they use a service or take a product. However, you might set up so that they're invoiced twice a month. So mid-month on the 15th, and then on the 30th of every month they get invoiced. Or, however the cycle works that suits your business and your customers. I would also look at reducing your terms. So make it shorter than 30 days. Some businesses will collect payment within 7 days, 14 days. 30 days is a long time, especially let's say you only invoice at the end of the month. So somebody takes a product or service from your business on the 1st of the month, you invoice them on the 30th. So it's already been 30 days that you have been without payment for this product or service. Then they get 30 days to pay it. So it's potentially 60 days before you're actually getting payment. So keep that in mind. Really look at your terms and shorten them because it's you that's out of pocket. Electronic invoicing is a great idea. Switch from paper to electronic invoicing. You know, if you can use a good bookkeeping system, it should offer follow-up services. Anything electronic is going to be a lot more professional than paper. It's easier to send. It's easier to store. You'll get paid quicker, I should say. And obviously, you know, if you've got automated follow-up, you'll be spending a lot less time on actually chasing up unpaid invoices. Now, you may have heard of e-invoicing or electronic invoicing. This is some emerging technology, and it's the automated digital exchange of information directly between a buyer and a supplier's accounting system. Now, with the introduction of e-invoicing, you won't even need to generate PDF or paper invoices. Essentially, you're connected to the same e-invoicing network, and then you can use accounting software like Xero to send and receive e-invoices. Now, the ATO says that it can cost over $30 to produce a paper or a PDF invoice compared to less than $10 per invoice for e-invoicing. So keep that in mind as well. All of the local government and Australian government businesses, or all of the government are on e-invoicing now. So if you can look at getting that set up for your business and you are working with government, that would be good as well. And my last point with regards to debtors is just to make paying easy. Offer multiple payment methods to your customers so that they can pay at in the way that suits them. Now, that could be credit card, it could be direct deposit, it could be BPay, but offer alternatives so that they can pay in line with their normal payment sort of policies and procedures. Assets. Assets are fairly straightforward. I would simply look at if you can free up cash by selling underused or unused assets. Now, businesses do accumulate assets that they at some point don't require. So if you can sell those unnecessary assets, it will increase the cash in your business. Could also save on costs for storing different assets, insurance, those kind of things. I would also look at leasing to free up cash. You'd have to consider if it works out better for you. But, you know, leasing equipment can sometimes remove the cost of maintenance and the risk of complete failure that requires replacement. Leasing also smooths out cash flow. So if it's appropriate for your business, it can be a really good way to free up cash. I'd also look at refinancing or negotiating better terms with any existing loans or bank agreements that you might have. So have a look at that and just see what you can do in that sense as well. Assets, like I said, pretty straightforward. All right, expenses. Now, very simply, expenses decrease the amount of cash that's available to your business. So I would always be looking at what you can do to reduce those expenses. Now, can you defer expenses or look at better payment terms? Can you rent a cheaper location or negotiate a better deal with your current lease if you've got land, or look at any other cheaper alternatives to any of those expenses that you would have listed on your initial cash flow forecast. So this could be as simple as your phone plans. It could be new plans and technology packages. There could be things on there that you know, subscriptions that you forgot you even had and you don't need them anymore. So have a think about that and think about when was the last time you reviewed each and every expense on your that sort of falls within your business. Review insurances, get quotes, shop around would be my advice there. I'd also look at the comparison in outsourcing versus in-house staffing. Now, that can be really, really effective for specialist roles. or particular tasks within your business. For example, bookkeeping, particularly with more automation, you might find that you don't need a full-time bookkeeper in your office, or even marketing and other administrative roles. You don't always need somebody sitting there full-time that is accruing leave, that you're paying super for, workers' comp, all that kind of stuff. Outsourcing, you might pay a higher rate, get someone that's more of an expert in that field, and only pay as you go. So I would certainly look at outsourcing, but we will also talk about staffing in just a second as well. Now, inventory is the next area that we're going to look at. Now, inventory is not relevant for all businesses, but if you do have inventory within your business, it represents cash. So if you're holding it for more than 90 days, it can cost you significantly. So with your inventory, think about whether you can source cheaper stock and materials. I would always review your pricing from suppliers and do it regularly. You may have a favorite supplier, and that's absolutely fine, but it's important to keep them honest as well, and do shop around. But I would always go back to your supplier and say, you know, I can source this product cheaper. However, I would prefer to continue my relationship with you. Can you match the price? In most instances, they're going to do what they can to keep the business anyway. So I would always be sort of double checking that. Your purchase power is an interesting one. You have buying power when you understand your own cycle. So when you can map out how much cash you have at certain times versus how much stock you use, you might be able to see if there's any efficiencies there. Now, to be very, very clear, once you've tracked your cash flow and you've got that cash flow forecast, it'll be extremely clear on what months you've got excess funds. So I would have a look and see if there is efficiencies where you can bulk buy to give you better rates. So that purchase power is a key thing. But in saying that, with your stock, you should always maintain the right level. So really managing your stock, making sure that it's not too high, but that you're never running out either. Now, I would suggest tracking the movement of your stock with some kind of technology if you can, or have processes in place to identify when new stock should be ordered so that you aren't running out. If you do have stock that you've purchased that remains sort of unsold for a period of time, you could try and return anything unsold, but you have to really understand your suppliers' return policies. Now, a lot of suppliers have become quite a bit more strict, I would say, with you know, COVID issues where all of a sudden shops were shut, so everyone tried to return things to get a bit of cash back in the business. So you might find that your supplier return policies are actually quite strict now. So that may not be a possibility. So in that case, you'll have to think about how to move it faster. Maybe you have a store and you might want to do some sales online, or vice versa. You have an online store and you do a pop-up to try and get rid of some stock. But using some kind of technology or a software platform to manage it is going to make your job a lot easier. You can do it manually if you're set up correctly, but just replacing that slow moving and obsolete stock with stock that has a faster turnover is going to be a lot better for your cash flow. So really know what sells well and what doesn't sell. Now, you could also consider drop shipping or just-in-time stock orders. They can be great if you can find a supplier who's going to provide you with stock only when you need it. It means that you're not wasting money paying for stock that's sitting in a warehouse or a storeroom or somewhere else. So that drop shipping can be really good. What it means is that you only order once you've had an order from your customer, but you have to make sure that there's no issues with quality, there's no delay on delivery to your customer, and you're maintaining that level of professionalism for your business. So really check that out. I have heard some horror stories about drop shipping where, you know, it's your business name that's on the line essentially. So you need to make sure that you've got that quality control. Now, the last point with inventory that I'd like to make is just really to use your supplier terms, make full use of your terms of trade, because that equates to an interest-free loan to you. So if your supplier terms are 30 days, then that's 30 days that you've got to sell the product before you're out of pocket. So don't pay early. Make sure that you're using the full use of the full terms of trade, and perhaps even suppliers based on what their terms of trade are, because if you've got a product that you've paid for but the customer hasn't yet bought it, you're the one that's in the middle and sort of missing out there. So keep that in mind. Okay, staffing. We did touch on staffing earlier when we talked about outsourcing in terms of reducing expenses. But when it comes to staffing, there are a few elements to consider, and this is a really key area that can become a major expense for a business. Now, in terms of staff management, rostering to cover demand to produce revenue is obviously crucial, but overstaffing will cost your business money and really affect your cash flow. So you really have to match the roster system to the peak periods and then have flexible staffing arrangements in place. Now, as I mentioned earlier, you might want to consider outsourcing if there's specialist roles that you could outsource. That way you're only paying on demand as such rather than having a full-time employee. So that can be really good for your cash flow. I would look at flexible workers and look at increasing the flexibility of workers. Can they have multiple roles or can they multitask as and when is needed? Now, aside from multitasking or having flexible workers, maximum utilization of staff is crucial. So thinking about setting targets to maximize the productivity of each staff member would be really, that's absolutely crucial as well. You might even incentivize sales with commissions or reward staff behavior that improves cash flow, like, you set sales targets around obviously sales that come in, but also set targets on reducing expenditure. It's a really good way to engage your staff. The key thing is if you are paying any commissions with sales or anything like that, they can only be paid once you've got payment from the client. Otherwise, again, it affects your cash flow. The next point I would say is to employ more qualified staff. Now, paying a staff member that is more qualified, so paying them a bit more, they're more qualified, can really increase your sales and your customer satisfaction, which in turn creates positive word of mouth, repeat customers. So it can be really good for business. But on a cash flow forecast, an unqualified or a cheaper staff member may look like a quick win. And it may look good on a cash flow forecast, but it can, in fact, be really damaging for the business in the long run. Now, you see a lot of this, and upselling and on-selling and general conversation and customer service comes with experience and age and training and that kind of thing. So really look at who your staff member is and make sure that that they are getting the appropriate customer service training, they are able to upsell and on-sell and really are communicating well with your customers. So really closely monitor your customer service. Now, when it comes to staffing and cash flow, retention is the absolute key to keeping your cash flow positive when it comes to staff. Now, if you can reduce staff turnover, that should be your number one goal because it has such a serious impact to bottom line. To your bottom line, I should say. Staff are really expensive to hire, they're expensive to train. So if you aim to be an employer of choice, you can really avoid those costs. You need to have staff that are the perfect fit for your business. And once you have them, absolutely do what you can to keep them. And that's where things like incentives and commissions and that kind of thing can really come into play. All right, so that covers the different strategies to improve your cash flow. As you go through and complete your cash flow forecast yourself, absolutely keep those strategies in mind. And then when you get to the point that you've determined if you have a profit or loss, you'll have to make some considerations. When it comes to profit, my number one tip would be don't be too quick to take it out. Invest it back in to manage your cash flow for future months or years, or use it to pay down debt. Now, if your forecast shows a loss, then you'll have to, again, make some considerations. You'll have to perhaps input your own money. You may have to get equity from investors, or you might have to speak to the bank and borrow to fill some gaps. Now, a very common scenario is an overdraft. It's a solution to seasonal cash flow issues or even debtor cash flow issues. Most banks, if you've got business accounts, will have a pre-approved amount for an overdraft that they can give you without question. So I would certainly consider that and have a look. And that, if you've got any areas and you go, look, every month we've got debtor issues where we've got no money at the end of the month because we're waiting on the payment run 30 days later, then an overdraft is the perfect thing. Some people even have overdrafts in place to get them through entire off seasons. For example, you might have a high season and a low season. So keep that in mind. But I would consider that. Now, the very final step, and probably the most important step of all, is really to review your cash or your estimated cash flows against actuals. So go back and check what you estimated against the actual cash flows for each specific period. Now, when you're doing that, you can highlight any differences between the estimated and the actual, and it will really help you see why your cash flow didn't meet your expectations. Now, it could have been that your sales were lower than forecasted, or your expenses were higher. So you might have to take different actions for different situations. So consider that. But do remember that cash flow is all about the timing and the flow of cash. So when you're preparing your cash flow forecast, you have to make sure you're as accurate as possible on the timing of cash flow and your estimation of sales and your analysis of the market and that kind of thing. So when you're comparing your forecast to actuals, it will all make sense. Otherwise, it will be vastly different and the cash flow would have, in fact, been of no use to you. So keep that in mind. Okay, now in terms of cash flow mistakes, there are some I guess, of the more common mistakes that I tend to see. One of them is running a business from your bank balance. Now, that doesn't account for any planned or unplanned expenses, or perhaps even the seasonal nature of your business. You know, you might have a low season and a high season, but it is very common for small businesses in particular to have a look at their balance and go, yeah, we can afford that right now, let's do it. So it can really, really impact cash flow. Another mistake I see is the improper management of taxes and government expenses. So these things are clear and they're known up front, so plan for them. Things like GST, super, PAYG, there's penalties for late payments across them all, and it's very simple to account for them. So do that in your planning stages. Now, spending too much money on sales is also a mistake that I see in small businesses. And as a small business, you do need new customers, but you've got to have a look at what the cost is to acquire them, essentially. Are you tracking that acquisition cost? And are you tracking the total revenue that each customer generates you? Because that has to be higher than the acquisition cost. Now, if you're overspending on getting the customer into the door, that might result in, you could spend a lot, you could get a small value customer that doesn't have much of a return. So it's in fact costing you money to get that customer. Now, a lot of businesses have issues with this particular area because they think that the more customers they have, the higher their profit will be, but discounting comes into play there as well. So when you know your customer value and how much the acquisition costs are, plus the cost of the sales, then you know how much you can charge or how much you could potentially discount if you were trying to drive sales. Another cash flow mistake for me is just simply not forecasting. It's a big mistake. And hopefully from the reasons that we've discussed today, that will be clear. Not collecting your cash fast enough is another big mistake. If your customers are delaying payments, but your supplier terms are short, then you're the one that's caught in the middle. Unpaid invoices are also cash flow killers. And what's worse than late payments or unpaid invoices is where a business doesn't raise an invoice at all. Now, I've personally seen it happen with companies that I've dealt with that forget an invoice here and there, and you're kind of expecting it, you're waiting for it, and I'm honest and I'll let them know to invoice me, but I'm sure that not everybody is. So it can be a really big problem for a small business. So make sure you've got strict processes and procedures in place so that nothing gets missed. Another cash flow mistake is holding inventory for too long. It costs you money. Like we discussed, inventory represents cash, so you don't want it just sitting there doing nothing for you. And lastly, probably the biggest mistake that I see is taking too much cash out. Now, do you as a small business, do you want to take money out of your business? Probably, I would say so. And you should as well, but it shouldn't be just sporadic and, taking money here and there. I would absolutely plan for it. As part of your cash flow, you need to know that you can afford it. And yes, as a business owner, this is certainly well within your right. You deserve it. And if you're not getting paid a wage through the business, then even more important. But you need to account for it and plan for it. Now, if you do suffer from negative cash flow, you certainly can recover from it. You have to find out what's caused the issue in the first place. You would have to change your payment terms, reduce operating costs, run promotions to get new sales or approach new clients, and then, finally meet with a lender and investor to try and get input. So there are, steps that you would take. But first of all, that identification of cash flow issues is absolutely crucial. All right, so that wraps up today's session on cash flow. I hope it makes sense, and I hope there's some things there that you can take out of the session to improve, or at the very least better understand the cash flow position in your business at any given time of the year. And I think that's really the key thing. It's not just understanding your cash flow at the end of the year, it's looking at it and planning it out as the year goes by. Now, I'm going to stay on now and answer any questions that you have. So shoot them through just by way of the chat functionality. Keep in mind, we have just scratched the surface today. If you want to know more or talk about any other aspect of your business, you can always book a one-on-one appointment with any of our advisors as part of the Commonwealth Government's Digital Solutions Program. Now, with this program, for $44, you get 3 one-on-one sessions with an advisor, plus you get a range of webinars and workshops to make up a bit of a package across all forms of business and all areas of business, but with a digital focus, obviously. In terms of that particular program, there is some eligibility around it. To do that through us, you have to be based in WA, Queensland or NT, employ fewer than 20 staff members and be operating for profit. So the link is on your screen to sign up for that if you haven't already. Like I said, if you do have any questions, shoot them through now and I'll stay on. But if not, thank you so much for joining me today, and good luck managing the cash flow within your business.